When the 2008 crash happened, you saw so many more real estate millionaires come up than any other time. You saw a lot of people lose everything in the 2008 crash because they were over leveraged in real estate. They were buying properties they shouldn't. They were taking on risky loans when they couldn't afford it. And then when the bubble burst, it gave opportunity for people who were now ready and educated to go and do something. I mean, that's when I started buying real estate. I started buying real estate after the 2008 crash. And you know, we're in Michigan, and we have Ford, GM, Chrysler as our primary economic drivers.
That's right.
And when the 2008 crash happened, GM went bankrupt, Chrysler went bankrupt, and Ford was on the verge of bankruptcy. So you had the biggest employers in our state pretty much almost completely wiped out, and you saw massive amounts of foreclosures. I mean, you had properties here selling in some instances for 95% off. The first investment property that I ever bought was a small condo, about 1,000 square feet. And prior to the 2008 crash, similar condos were selling for between the ranges of $120,000 to $150,000.
Wow.
So they were selling between $120,000 and $150,000, but I was able to come in and buy it for $8,000 cash. That wasn't the down payment. That was the actual price of the condo, $8,000. That means unheard of in this market. It's a good area, right next to a bunch of shopping, in a good school district. And I bought the property, put a little bit of money to renovate it, and I rented it out for for $600 a month. And I was just getting started in real estate, so I made a ton of mistakes. But that was the type of market that we saw. And I mean, there was just so many different types of distressed deals for people who were financially prepared, people who were financially educated. Now, I wasn't very financially educated, and I didn't have a ton of money with me. I was in college. I was running my event planning business, and I was making decent money, but I was funneling that money into assets because I started reading books about money, and every book said that every wealthy person invests in real estate. I had no idea what the heck that meant. I didn't have any real estate investors in my family. I told my dad, I want to invest in real estate. He was like, "You're stupid, go study." But I was like, this is something that I wanted to do. Anytime I was actually studying for my MCAT, the medical college admission test, and anytime I took a break when I was studying, I went onto the news, Yahoo Finance, and it said that real estate prices hit rock bottom. And to me, an $8,000 condo was normal because I hadn't known anything else. Yeah. That's all that I knew. And so, I started buying. I started buying as many different things as I could because I was like, well, I'm making a little bit of passive income. I made a ton of mistakes, but anytime I made some money, I was buying properties. And as I started to grow, I started to buy bigger. And you saw all different types of distressed deals. You saw physically distressed, which was where properties were physically beat up. And, I got to meet a whole bunch of different contractors. So we were doing a lot of stuff with renovations. I got to be pretty good with that. And then we also saw financially distressed, which was, there was a property that I bought. It was an apartment complex, 20 units in a great area, growing area, probably worth $1 million. We were able to come in and I bought it for just over $400,000. Mm-hmm. Why? Because it was vacant, or mainly vacant. The people that were there were not paying rent. It needed a little bit of work. And the owner was so overly leveraged. It's interesting because at that time, there was this big thing on zero down real estate. Buy real estate with no money down. Mm-hmm. And the owner of the property was actually one of those real estate gurus. And he used to teach people how to buy properties with no money down, how you can create cash flow with these properties. And as I started to go into this deal, I looked up the owner. I saw that he was this guru teaching this, and I went onto his website, and he had this course or whatever, and the homepage of his website was him in front of this property, this 20-unit property, which now he was foreclosing on, which was being foreclosed on, that I was about to buy for 40 cents on the dollar. But he was talking about how he bought this property for like $1.1 million with very little money out of his pocket, and how it's making him rich. And then that was the property that the banks forced him to sell because he had so much leverage, didn't know how to manage the property, and then we were able to come in and buy it for pennies on the dollar.
Wow.
So market crashes are a part of our economic cycle. You see booms, you see busts. There are times where the market goes up, and there's times where the market goes down.
Yeah.
Now, 2008 was an exception. I mean, it wasn't things going down. It was like just a cliff. It just went poof. Like it was pretty wild what we saw in 2008.
Yeah.
Now that I look back and kind of really understand it. But market crashes happen. They happen in stocks, they happen in real estate, they happen in cryptocurrency. You see it happen across all asset classes. And the mistake that people make is either A, they assume that no market will ever crash, or B, they try to just perfectly wait for the crash. Now, let's start with A. You assume that no crash is ever going to happen. Well, this is where people get greedy. People
Right.
they get emotional. They invest on emotion rather than financials. We talk about it all the time. When you invest on emotions, not financials, now what you're doing is when the market goes up, your friends start to get rich. They start making all this money, and you hear about your friends making these trades or investments, and they're doubling their money. And you're like, holy moly, I need to get in on that. I want to make some money too. So now you're buying way up here. And what happens is you get the media effect. And what the media effect is as the market is going up, that's when the media comes out and they start reporting on it. They say, oh my God, XYZ stock asset is booming. 19-year-olds are becoming millionaires. People are getting rich. Don't miss out on this opportunity. Buy now.
Yeah.
What that does now, it creates this new frenzy. So people now start coming in, they start buying more. And this pushes this asset class to above normal. And it just keeps going. And that can be fueled with the help of easy debt, cheap leverage, because if people have access to debt and leverage and easy access to it, then that just makes the bubble bigger, because now people can put more than what they're willing to lose. They put in their own money, they put in margin from the broker, they might go into credit card debt, they might refinance their home to now take this cash and put it into this thing which looks like is making everybody rich. It's a guaranteed way to get rich quick. And people, as much as we want to talk about it, people have this innate want to get rich quick.
Right.
It's like wanting to lose weight fast. Who wants to lose weight slowly? But if you want to actually lose weight sustainably, you got to put in the work. If you want to actually build wealth, you got to put in the work. There's always going to be people who are greedy. They want to get rich without putting in the work. And so that's what happens, right? That fuels the bubble even bigger. And then you get to this point where people are looking at this investment. They're looking at the fundamentals of their investment, and they're saying, holy moly, this asset is worth a lot more than it probably should be worth. Maybe we should take some profits off of the table. So then you have some of your fundamental investors that are now cashing out a little bit because they've seen gains which are a little bit rich, and so now they sell. And so that's when you start to see the market turn a little bit. Once you see the market turn, the people who were buying really high start to panic, and they say, oh no, maybe I should sell. Maybe I need to start selling. And then you start to see it go down, and that's when the media comes in and they say, this thing is on its way down. The bubble has burst.
Yeah.
Get out while you can. Now what happens? They sell. And now your fundamental investors come back and they say, holy cow, this asset should be worth a whole lot more money, but it's selling for way cheaper. Let me come in and buy. And so that's what creates these boom and bust cycles. It's people that get excited, they get emotional, they get greedy, they want to buy. You can leverage that up with cheap and easy debt, which allows it to go even higher. And then eventually it gets too high. It gets, this might be your baseline of where it should be, but it will go above that baseline because of debt and emotion, right? And so then once it starts to turn down, then it will go below baseline because, again, debt and emotion. When people start selling with debt, now not only do they lose that $100 that they put in, they lost the other $100 from the stock brokerage, which causes it to go down even more, causes the bubble to go down, causes a whole bunch of other issues. People panic, people get scared. The media is now talking about how the whole economy is about to implode, the world is going to end. People get scared, so they start cashing out. And that's what causes it to go down, and this is where now the money is made. The money is made when you buy. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.